Good morning, everybody. We're excited to be partners with NYSRA on the transformation project. We know it's an exciting time in the field of developmental disabilities and those who are running work centers trying to figure out what are they doing in the future. Our talk today is really about business transformation, and when you begin to talk about the changing business models, this not only relates to the world of business as it is with the work centers, but it relates to every segment that an organization faces. So much of the relevance today will be applicable across all business ventures that the organization looks at, and we look forward to helping you provide insight into areas you should be exploring when you're looking at changing your models. So we will be providing an overview today. We want to talk about the effect of funding in the funding environment today, and as we all know, there's not the amount of dollars that used to be in the field, and the ability of trends is diminished. I do want to quickly review the OPW's integrated business model because, again, this is being done on behalf of a BIP grant that NYSRA's taken part of through OPWDD, and we need to be looking at how organizations can move towards this model. There are considerations for existing businesses with program structure change if you're considering a structure change, but there's also considerations for a new business venture as well. Some of the particulars we'll be getting into are some impacts for ongoing costs as well as some CFR impacts that you might not have thought about when you're considering various things that should be looked at when it comes to business changes.
And if you've listened to prior webinars that Laurie and I presented, many of them have similar or common themes because all the discussion that we keep on having with regard to strategy, with regard to for-profit business ventures, there's a lot of inherent items that organizations need to think about, and you'll hear some of those themes again here today, and we'll expand upon them and go into further areas this morning.
We remember a few years back of the good times. I remember when we had the trends on steroids or triple trends and those components, and we well know that those times are gone, unfortunately. But at that time, you look at running the business, and even though we felt challenges and stressed with the whole thing, it was relatively easy in comparison of how it is today. You know, we're looking at things very differently. You know, banks freely provided loans, states continually provided funding, and agencies were growing on a regular basis. And you think about, we used to get a PPA approval on something, and you could go to the bank and have a guaranteed floating of cash going forward. And those days are somewhat diminished, even though you might get a PPA. I don't think banks are looking at that as the contract guaranteed payment that they used to look at in the past.
No, and the banks that are involved, there have been a number of them who really understood the industry. Some of those banks are no longer participating in the special need industries, or the O industries as we call them here within the firm. And as I'm sure everybody is experiencing, it is that much harder to be profitable. It is that much harder to raise additional fundraising. And there's a lot more scrutiny. So for instance, when banks are providing loans or they are looking to give you a line of credit, I personally, as a partner in the firm, have received many phone calls about organizations asking, one, do we audit the organization? Did we help them with the financial statements, etc., because they are doing that much more due diligence as opposed to just free flow of money. In addition, as Laurie was saying, we used to live in the world of super trends, which were wonderful, that you got 6+% trends each year. Those have not been seen for a very long time. Quite the opposite. We're in an era of everybody and every state agency auditing all the providers, OMIG, OSC, whoever it might be, coming back, coming up with findings left and right, and asking for money. So with all of that and the change in the funding, rate rationalization, and so on, and certainly with the change with regard to transforming the work centers and the requirement to move into a different type of environment, you do see that this is a less of a positive environment. I won't say negative, but less of a positive, much harder in order to operate.
In other words, it's tough times, and I think you all know that. I can't say the times are going to be getting any better, and money, the cash flow situation is going to be critical going forward. So it's something we need to be thinking about. I can tell you when you roll into managed care, cash flow will even be strained further than it is today. So I just like to put out the bad news initially, because again, we still need to learn to survive and thrive at the times that we're moving forward. As Allan brought up, banks do not always renew line of credits. They're going to look at your financial picture to determine whether or not that should be renewed. I can tell you getting financing anymore is more and more difficult, not only for businesses, but even in the personal world. I recently obtained a new mortgage, and the hoops and paperwork you had to go through, the banks are doing phenomenal due diligence anymore that did not take place. So it is harder to get loans, and it's not going to be getting easier, I don't think, in the near future. We know that our funding is been either frozen, or in reality that ends up being with a reduction, because as you have inflation taking place and costs going up, you don't have the funding that you used to have. You look at the impact of minimum wage and how that is going to be rolling forward. While the state is making this whole on the people that are not making a minimum wage going forward today, they are not taking care of the compression factors. So dollars are going to be tight. We do see agencies either deciding to close a line of business, go out of business, so there's a lot of transferring opportunities that are taking place, but it's something that each organization needs to be looking at, is what is my core business and do I keep it going forward? There have been significant budget cuts, and I know some organizations have had to do staff layoffs or hiring freezes, and the theme is do more with less. This is true in the DD world, but it is also true in many other human service sectors throughout the state, as well as healthcare. Every type of business I begin to look at, I don't see anything growing leaps and bounds when it comes to anything that has government funding tied to it when it comes to Medicaid or Medicare.
And with that theme, think about your own organization. Think about what you've been experiencing over the past 2 to 3 years. Profitability, whether that has stayed constant, it has dropped within the organization. As Laurie indicated, there are much more mandated costs that you have to incur that are unfunded. There's a whole slew of compliance that has been put in place over the past number of years. So doing more with less certainly is going to be a very common theme of what we'll be talking about here today, and setting the stage with regard to a changing business model of really looking inherently, understanding what's going on in your organization, because if we don't really understand that, it's going to be very hard to change your model, to become efficient, to move into a for-profit environment. And a lot of agencies really think that mergers or acquisitions are the answer to everything. However, the problem that you find is that those mergers or acquisitions start way too late in the game, and the one organization that finally realized that they would like to merge or acquire does not have the balance sheet, does not have the wherewithal to do that, and then, of course, any potential liabilities that might be on the page, we do have to worry about those with regard to funding and the viability of organizations as we do go forward.
And it's not that we're promoting mergers, acquisitions, it's just as economics get tight, organizations begin to look at their survival and moving forward, and how do you keep the mission pure within a community and really develop those leverage partnerships that you need so that you can sustain your mission.
So where are we today? New York State budget deficits, lack of funding, administrative efficiency adjustments actually started back in the 1990s, if everybody remembers, in the community residence programs that we used to operate that have now transformed. But that also goes further with regard to the rate rationalization, different factors that your reimbursement is not totally directly related to your costs. We do have to worry about EO 38. If there will be any potential ramifications on there. Organizations have now been filing those for 2+ years. I was at a committee meeting yesterday with the State Society of CPAs, and the question was asked whether or not any anybody had any clients who had any contact from the state with regard to their submissions, and there was a resounding no. But there have been a number of lawsuits with regard to whether that's a appropriate executive order or not. Seems though that the courts have leaned at this point with the state. However, there are a number of appeals out there. So potential cuts with regard to that, lack of ability to pay executives in excess of certain amounts, certainly if you are a single-funded agency. We talked about before the lack of trend factors as opposed to super trends that we used to have at the end of the day, minimal increases that we might have, but again, with all the changes through the reimbursement methodologies, a lot of agencies are getting cut. Those few agencies that get the benefits from the rate reimbursement changes is few and far between. We do see in state budget lines specific items being decreased. So very importantly, as we talk about the workshop and the requirement to move into a different type of a venture, something that Laurie and I have experienced through our consulting of what we termed the T12 members in the original transformation process, was that many organizations really didn't look to understand or really look to budget whereby they were decreasing state dollars as part of their operations and needing to go look for different avenues of funding. Medicaid dollars are now switching to Medicaid managed care. Managed care is a whole different world as we've learned over the years, and yes, the issue of cash flows is going to be big, the collection of receivables and potential write-offs, but more importantly, what does an organization need to do in order to gear up for it? Are there additional costs that might be incurred that you're not going to have funded? We know the Office of Medicaid Inspector General is running around doing audits. They give you a work plan every single year, different things that they are looking at, and I've looked at many OMIG audits through organizations, through the websites. I know of one that came out with no finding and no take back at the end of the day, because it's very easy to reinterpret. It's very easy to not have everything fully in place within an organization, and it does lead to potential takebacks or reductions in your reimbursement. And then, of course, work center integrated business models.
Now, the decrease in Medicaid dollars, when you look at what New York State has done, they are down to 2003 spending level per capita of the Medicaid dollars. So you think about, we're now 2016, the state has effectively controlled the Medicaid cost on a per head count. It's amazing, yet at the same time we're all feeling the pain with that. With the Office of Medicaid Inspector General, they do have targeted dollars put in within the state budget for take-back of Medicaid dollars across the state. So they may or may not hit targets, but that is an area that, in fact, that is part of how the state formulates their budget going forward year to year, is there's an assumption that there is going to be some take-back in dollars. Now, integrated business model, just to refresh everyone's mind, I'm sure you're all very familiar with this, because the plans are due, I know, later this year, and I know the transformation won't be taking place until, or needs to be completed by 2020. But I just think it's important that as you look at your business, you have this in front of you so that you can continually look at how you're going to be doing this. Model 1 basically is 40% or less of the workforce consists of people who receive OPW, DD, HCBS waiver services. So again, I think the state has been very good at effectively defining this. So, you know, if you're aware, HCBS services are now rolled out as well to mental health and OASIS, the behavioral health component. If you do have a person that is receiving those HCBS services, they're not counted as part of that disability population. You're really talking the DD population. They're looking for an opportunity for the people with disabilities to be able to interact with people without disabilities and really being treated as all other co-workers. So if you do have staff providing habilitation services, they are not counted as co-workers. So if you have a worker within your work center that is doing pre-vocational services, that does not get counted into a peer co-worker type person, just to be thinking about it. They're looking at all benefits being the same for employees, including the schedules, the breaks, lunch, time off, etc. They're looking at people with disabilities not being isolated, and then of course the HCBS heightened scrutiny standards must comply. With the Model 2, it is the same as Model 1, except you're allowed a greater percentage of the workforce to consist of employees who receive OPW HCBS services. The added burden that you as a provider have to comply with Model 2 is you must provide a description of your efforts to recruit people without disabilities. They're really going to be testing to make sure that are you really making full efforts to really get a fully integrated workforce in place. And they want to make sure that you're not really segregating populations. So that's going to be tested very significantly. This will allow the Model 2 for the continuation of the Source America contracts, the old niche contracts, because again, you're allowed to get up to 76% of your workforce having people with disabilities.
So changing business structures, success into the future, there are a number of things that we need to talk about, we need to think about, and certain things that need to change. So as you see on slide number 8, we do talk about the executive leadership thought process, board of directors and board oversight, staff alignment, mission vision alignment, impact of and education of service recipients, and fiscal impact of the change. Each of these areas have specific items that we need to focus in upon. So executive leadership thought process, that is your upper management. So the CEO, the COO, the CFO, and that key team running the organization on a day-to-day basis. How do they look at their business model? What type of profitability have they built in with regard to their programs? How do we look at loss leaders within the organization? And do we have the ability to think in a very quick manner, make changes in a very quick manner, and make sure that we are attentive and make the changes necessary that businesses need on a regular basis in order to survive? Because when you think about the programs that you might have been operating through now, whether it be group homes, whether it be MSC programs and so on, we do know that those will continue on for whatever period of time. Changes come once a year, maybe a couple of times a year. Yes, you do receive multiple rates during the individual fiscal period, but we do need to very importantly think about that leadership thought process. Are they geared up? Are they ready to think differently in terms of a for-profit type of mentality? We will be using that language, of course, as we go forward, because we do have to understand profitability within each of the programs. We do have to understand the allocation of costs, and yes, that dirty word, cost allocations and cost accounting, that we will talk a little bit further.
You know, looking at this, I know, Allan touched upon looking at the profitability of each business line. All of the providers are going to be facing those that provide MSC services that change in the coming year as well. So many of the principles we will be talking about today will apply here as well, especially when you get into administrative allocation and some of the fiscal plan allocations. So it's things to be considering. And in fact, many organizations, when they look at their MSC model, it may in fact not be covering costs, so it may be an opportunity to recoup some dollars there. But there's some carryover that you need to be looking at. So much of what we will talk about today is relevant to any time you're changing your business model or looking at adding or decreasing a program. So it's really critical that you begin to think in a broader sense to understand the ramification of those cost expenses. You might not have, things to think about. We talk about a board of director change and board oversight. What we're really referencing here is you really need to look at your who's on your board. Do you have those key stakeholders there that can help you with some of these decision points? Do you have someone of influence in an area of business that you're considering? Yet at the same time, you need to make sure that board keeps the oversight and does not have a conflict of interest. So it's walking that tightrope and having board fully understand fully what those boundaries are that they need to be following. But I'm not sure when was the last time you actually did a grid looking at your board complement, saying here's who should be on, here's where we're deficit, here's someone that might be beneficial, so that we really can position ourselves for the future. And Allan and I will be covering much of this next week, so I don't want to spend a lot of time on the board, but it's just something you need to be looking at. Does your board understand running a for-profit business, and are they quick and nimble to make those decisions?
That's the key. Being the president of a not-for-profit organization, I know how long it takes to make decisions. I know how long and hard it is to get everybody together on the same page and have that consensus at the end of the day. In the not-for-profit that I am the president, I have a relatively small executive committee. We just expanded it to 5 people. Sometimes to get the 5 people on the same phone call could take a week in terms of scheduling their time. So it is imperative to know how things can be done quickly. We actually are trying to move to one of those chat rooms because it seems to be inefficient to do things through email these days. I don't think so, but other people do. But we do have to understand that process with regard to the attentiveness of the board, and as Laurie did say, the expertise of those individuals. Of course, staff alignment is going to be key. In a not-for-profit environment, you need to think about your structure, you need to think about your layers within the organization. So how many layers of management do you have right now? I did a study a number of years ago with an organization funded by one of the O agencies, and basically what they had done was they were humming along for quite a long time, making profits every single year. Yes, it helped that the CEO of the organization would not spend a penny if she did not have to, God rest her soul. But at the end of the day, they were starting to lose about $1 million a year. We went in, we looked at it, and basically we found that they had an extra layer of management in the middle that the senior management thought they needed, the program people thought they needed, but it turns out once we looked at each of the individual positions, their job responsibilities, that 3/4 of them were not necessary. And they did change their staff alignment, they did cut back the cost, they became profitable again. But also think about little things like administrative assistants or other people within the organization. Everybody these days kinds of types their own letters, we do our own scheduling, we do a lot of things ourselves. So do we need the full complement, and can we afford, more importantly, the full complement as we go forward into a different business structure?
And every conversation Allan and I have had regarding business change, we always go back to vision and mission. And it's really critical that you pull those documents out and begin to look at those, because is this core business that you're doing really aligned? Or is a business that you're looking at getting into that's going to be part of the corporation in the future, does that align? And it's really critical that you do that whole hard questioning up front before you venture into something. You know, we will have changes going forward, and there's much education that needs to go on service recipients as well as staff. If they don't understand why the change is taking place, other than saying, oh, government's requiring it, it's really hard to buy into the philosophy. And in reality, internal sabotaging can take place when you're looking at changes of that nature. So you really need to figure out those key educational strategies that are relevant for both staff, for the community, for the board, and service recipients as well. And last but not least is the fiscal impact of the change. And it's very easy to roll up and do, well, I find it relatively easy rolling up and doing a P&L to see here's the gross impact of the change. Yet at the same time, a lot of what we'll be covering today are some of those carrying costs that we don't often consider if you don't look at just not the day-to-day P&L. It's that ongoing impact that things do carry forward as we run a business. So it's just something that needs to be considered.
So just to push a little bit further, so when we're considering change, how is it going to affect each of these constituent groups? So executive leadership, do we have the right team in place with regard to new ventures or for-profit ventures? Some organizations that we've talked to have looked to hire a for-profit business specialist, which is a funny name if you think about it, but basically somebody with an entrepreneurial spirit who has the ability to think outside the box and think about growing businesses. Do we have that type of individual in the organization? What type of support might they need and help us to change as necessary? The board involvement we talked about, and again, do we have that right expertise? Do we have people who all work in businesses right now? And I think it really is a good process, as Laurie said, to go through, make that grid, understand everybody's expertise, and you might be looking at some board members in different ways that you never thought about before and how they can help you with regard to their own expertise within your type of business or moving that forward. The staff involvement, very simple. In terms of, again, do we have the right staff members to support the executive leadership? Do we have the right type of thinking within our personnel who will move quickly, who are not people who will take things in stride and basically not move things in the right direction? That does hinder the ability for organizations to be profitable as they go into the future.
With staff involvement, too, I know we did not put this out here. Again, in my previous job as executive director, I was fortunate, with tongue-in-cheek, to have a union job. And this is not to say anything against unions. In reality, it's just what we had, and probably 80% of our workforce was unionized. So when, in fact, you're looking at business changes, it's really critical that you engage them, but strategically you need to be thinking about when do you engage them, because they can in fact sabotage moving forward with the business development. At the same time, they need to be part of the solution of how do you move this business venture forward. I've had to sit down with the union in the past when I've had difficult situations and say to them, listen, if you don't get on board, you have the possibility of losing staff and membership, which is really one of their drivers. So either help us facilitate this so that you can in fact keep that membership whole to some capacity, or find a way to really structure through that process. So it's just something we did not clearly delineate here, but it's just with staff involvement, and if you are unionized, it's something you need to think about. At the same time, if you're not unionized, you need to be thinking about that as well, because often when you're making these significant changes, if you haven't done effective involvement, it is an opportunity for a union to come knocking at the door, especially when there haven't been trend factors in place. So
in terms of community involvement, that's actually a very important part of this process because as you think about changing your business models, you can't just do it in a vacuum. There has to be some type of market study or market understanding as to what your community might need, what they might tolerate, what they might not be happy with at the end of the day. I don't know if I'm blessed or cursed of living downstate on Long Island, and I think Long Island is the king or the emperor of not in my backyard. So basically, as an organization, what are we going to think about doing into the future that might upset the community, might be very beneficial for the community, but very importantly, in terms of a market aspect, what does the community need? What services are lacking in terms of the types of services you can provide as an organization? What type of for-profit business can you provide? For-profit businesses, as we'll talk a little bit further in the discussion today, most of them do fail within the first year, so that is something that we do talk about quite a bit during our discussions. And when you think about it, was it something that you actually needed to put in place within that community? And give you an example. Down on Long Island, we have had a lack of what we call Dairy Queens, and I know upstate there's a lot of Dairy Queens. They call them DQ. I grew up working up in Rockland County every single summer, so fell in love with their dipped cone. Down on Long Island, all of a sudden, one of them opened up, and there was an article in the paper the other day that said that 20 more will be opened over the next year to two. So the requirements for getting into such a franchise are not huge, but I've talked to a number of people. They say to me, well, you can't just own one. You need to own multiple for that to be a viable type of a business. But that's a unique type of thing. That's a brand name with a franchise that is being brought into the community that people will go after because they remember it from a childhood, from whatever it might be. Is there something in your community that is necessary, that is needed with regard to that change as you are thinking about new business models or new business ventures going into the future?
Ironically, as Allan brings up the DQ, the Dairy Queen, you know, the next comment is government agency. And if I put on my old hat, I am a registered dietitian, have done a fair amount with certified sanitation and all of those elements, and there are some significant requirements from the local DOH in terms of those standards. So you really need to know when you venture into a business what arm of what government agency might you be butting up against. And the obvious ones usually pop out, but you really need to research that. I also had experience as well. Back in the year of being a hospital administrator, we were looking at converting our laundry to commercial laundry opportunity, and again, huge community involvement, government involvement, because you're now dealing with wastewater, you're dealing with water consumption, you're dealing with all these things that you don't always think about. So yes, we're used to thinking of licensure and those components, but as you venture into any business, most likely there is going to be a government entity that's going to be knocking at your door, and you better have the answers ready for them.
And with that said, you know, we think more about for-profit businesses as opposed to the not-for-profits that we all have a lot of experience with. We do understand regulations. We learn that we figure out what we need to comply with before we start a program, or at least 99% of the organizations do. In the for-profit world, you hear the term leap first and then look later. That is a very different approach than anything that all of us have been involved with over the years. So it is very important to understand the complexities of those governmental regulations. I'm not a believer in leaping first and looking later, but you do have to make sure that you do understand everything with your eyes wide open. So things like private dollars, what is their involvement with regard to a change in a business model? How will you affect your not-for-profit organization if we are moving away from certain services that we've been providing and moving into that for-profit area? So private dollars could mean fundraising. Private dollars could mean investment in a for-profit business. So we do have to think about what ramifications might be in there. Would the corporation, would the individual want some type of a say or a large say within the business in terms of that? I dealt with an organization, and I still work with them over the past number of years, where they were approached by a developer, and they wanted to put up some low-income housing. And at first, we were brought in looking at some due diligence. We were very skeptical that the developer was looking for the benefit of the agency, because we're always very concerned about not-for-profit rules and regulations. And after a lot of due diligence, after a lot of research and experience on the ground, the organization went forward. They've opened up a number of housing projects at this point in time, and it is a mutually beneficial relationship amongst the not-for-profit. The consumers are getting served at this point in time. They have for-profit businesses on board because a lot of the low-income housing is done through for-profit entities. So you do have to think about how those private dollars might be used, might impact you, and how it might be beneficial to your change as you do go forward.
I know you are all deep in looking at how the person-supported involvement is taking place, because part of the plan that's required with the integrated business model is really looking at how many people want employment and what is the end game for this individual. So you're very much involved with those components right now. And again, I think we brought up alignment with mission. It's really critical that you make sure whatever you get into or decide to divest of, how does that align with mission overall?
And this next slide, I think Laurie and I could agree that it's probably one of our most important slides that we have as part of our presentations, because business plans we find are not fully thought out. Many times we'll ask the question, have you created a business plan? The answer is no. These are very, very important. They are formal business strategies, propositions that you're going to be going through. They do take quite a bit of time in order to develop the right type of a business plan, because you need to think about all the different options, the ramifications, the pitfalls, and you need to have different viable options if one part of it does not work. So once we do have that plan hopefully created, we do have to make sure that we have the appropriate communication strategies to all of our constituents, that it is a viable type of an item. What is the fiscal impact of these changes? Hopefully they have all been delineated through that plan, and as we look at that, what specific steps are necessary to minimize any potential impact. And just as an example, let's say as you're moving forward, and Laurie talked a little bit about before MSC and the potential impact on your organization. What is the new term? Conflict-free
case management.
Case management. So if you are no longer able to provide those case management services to your consumers, they're going to go out to somebody else. You lose, let's say, $300,000 worth of revenue in the organization. You drop off the expenses accordingly because you're very prudent. You're doing everything the appropriate way. How does that expense, and let's say the revenue and expense match in this situation, even though we know they won't, but how does that impact administration allocations? How does that impact other areas of the organization that you might have to cut back on because we're not running that program any longer? So all these things are part of the fiscal impact of change being thought about as part of our business plan and strategies, and very, very importantly, timelines. Is it viable? Do we do a 6-month plan and jump into something? But certainly 1 to 3 years of a business plan is the minimum that we want to look at. We do want to see more of a 5-year type of a strategy so that we know where we're going, but also to be able to change things as necessary when we're finding that they might not work. So this business plan, it really, really needs to be focused in upon, and we have, sad to say, cut down quite a number of the ones that had been produced through the prior process because, again, they're not looking at the change that's necessary. The impact of different dollars within your organization. So if all of your SEP money goes away, if all of the pre-vote money goes away within your organization, how are we going to still operate? How do we have the ability to unwind that type of a structure to minimize the future impact to us? And then as we're gearing up with some type of for-profit business, where do we get the seed money for something like that?
And, one minor thing in a way, but don't forget your operating certificates. You can't leave them just hanging out there. There is a process involved with surrendering operating certificates when you no longer operate a certified type program. So it's just something you need to think about. So process for change. Some things you need to be thinking about, again, is are we restructuring? Do we get into collaboration and partnerships? Is the service continued? Do we transfer the operating certificate, or do we end up with a full-blown merger? And we want to talk a little bit more about some of these things so that you have some understanding of options that, in fact, you might be considering.
Okay, so as we're looking further, we do want to talk about some restructuring items. Options, as part of the process. So as we're looking at it, there are a number of different options with regard to restructuring, one being a merger, some type of consolidation, a dissolution. When we look at these and we are understanding the concepts that go into this restructuring, the merger probably is the easiest one to understand, where the organization's corporate life and assets and current and future liabilities are absorbed into surviving corporation. I'm not going to talk about the different accounting requirements because those are ever-changing, and I don't want to bore everybody here today. But what are we thinking about with regard to the name of the future organization when there is a merger? What is our brand as we go forward? There's a whole bunch of technical items that we need to worry about with regard to bylaws, with regard to corporation changing of your name. As Laurie and I have experienced with regard to licenses, how do we get those operating certificates changed? And I've experienced over the years in discussions with state agencies saying that, well, if you want to merge or give that license to another organization, you don't have that ability. You actually have to give it back to the state and then compete for obtaining that operating certificate back again in order to serve that population. So we do have to think about a lot of things on the merger. Again, what are the viable partners, a whole bunch of due diligence items that we have to worry about. We've given a number of different sessions with regard to those particular areas. Consolidation. So corporate life and the assets of two organizations being combined into a newly created corporation. Different ramifications, new IRS exemption requirements, different corporate structure issues that we have to worry about. Never mind, we're not going to talk about here today all of the impact on the back office and how you bring two different sets of systems together. What is the most beneficial way of doing that as you go into the future? But we do have to think about this as we are going through our options of restructuring. And then at one point, there will be potentially a dissolution. One organization may go away. Remaining assets will go to a similar organization with a similar mission. But there are a lot of protocols. And while the Charities Bureau has made it easier for organizations to merge, for organizations to work with each other, there are significant hoops that you need to jump through in order to obtain that. I dealt with an organization that wanted to fold a small foundation into the parent corporation. It took 19 months for that process to happen, and that was even after the change within the law that made it easier, because as they said, well, we don't have to go to the Supreme Court for things, the AG's office still is on the fence with regard to fully approving where those assets are going. There is a full accounting of how things need to be done, a whole protocol that has to go on, so we do have to worry about that as part of our restructuring options if that is one of the areas that we're going to be looking at or moving towards.
And we always thought closing a business was easy, you know, when you think about it. It's just really understanding all the tentacles behind that.
Oh, yes. Oh, yes. Continuing on, affiliations. That is usually the start of a process. A lot of people will start some type of corporate affiliation and they'll dip their feet in the water, see if the other organization might be a viable partner, see if the culture certainly does mesh or not within the organizations. And as we're looking at it, there are different entities or and type of structures that we can think about. One might be a subsidiary whereby we do have one organization that does govern or controls the other. Basically, you might have a sole membership, you might have a controlling number of board members within your bylaws, but when we're looking at this type of an affiliation, we do again have to think about how it's going to work out going into the future, because if there is some type of sole membership where you do now have a control, if we do have to unwind it, what are the ramifications of that because it didn't work out? Related entities is very, very common these days. So we might have multiple sets of corporations whereby there is no controlling interest. We might have common board members, but at the end of the day, they do operate separately. So we do have to worry about whether or not there is different requirements for reporting, but in terms of changing business structures, those related entities might be an easy avenue to change the structure, because what you might find, for instance, through a related entity affiliation, one other organization that you're working with might provide a whole different set of services than yourself as a not-for-profit. Will complement the different services that you are providing, and let's say you're looking to take on an additional service that neither organization might have done before, you can find which one it will fit in best, because they have the expertise, they have the staffing in place in order to service that type of relationship and make sure that it is viable on a going forward basis. Joint ventures, we're seeing a little bit more of those in terms of the industries where they will do a single or a specific project or purpose, and once those joint ventures complete their purpose, they usually do fold up. There are a number of ramifications with regard to reporting, not just within your financial statements, but also with the Internal Revenue Service. But if you do get into a joint venture, we will speak specifically about those with any agency that would like to. And then contractually, but no membership or governing ties. A lot of organizations have tried that in terms of getting started, whereby we might decide that you're going to outsource the clinical offices, you might outsource the finance office to another organization, no membership, no governing ties to each other. We do have to worry about UBIT implications with regard to potential items like this if it's not in your basic mission. For instance, I dealt with an organization a number of years ago that was looking to do back office work for other not-for-profits. We got the attorneys involved, and the first thing that they said was that, you know, if you're providing fiscal services to an unrelated not-for-profit and it's not in your mission, that's going to be unrelated business income. My side of the story was, well, maybe that's not a bad thing because you're making more money, you still have it coming in, you might pay a little bit of a tax as part of it, but you are moving forward in terms of your viability, in terms of your strategy going into the future. And certainly any of these entities can be for-profit or not-for-profit. One of my largest corporate structures that I deal with right now has 21 corporate entities. 5 of them are for-profit entities. The rest of them are not-for-profits. A couple of them, yes, they're not doing anything right now because they just set them up to move them into the future. But there are ramifications in a corporate structure with not-for-profit, for-profit. One thing that I'm looking at very, very carefully and very closely are if a for-profit entity had losses over the years, and let's say there's some type of a loan or some type of due to from between the not-for-profit and the for-profit, was that not-for-profit able to give the dollars to a for-profit as part of it? But more concerning would be if the for-profit never or did not generate enough revenue to become profitable and can't pay back the not-for-profit that seed money, are there implications to the organizations themselves? And more importantly, as I go through that, and when I write off a receivable from a for-profit, do I now have a taxable transaction? So there might be things that you might not be thinking about that could come out of these types of relationships, these types of corporate structures that are very important to get on the table and understand before we even move into them.
So my big takeaway from all of this discussion that we've been having on the restructuring options, get yourself an attorney that knows about corporate structure to involve your accounting firm, because both entities look at different aspects of moving forward in a structure change, and you need to be looking at both aspects that they will be touching upon, and they should be working hand in glove so that you don't hit an aha down the road. You know, when Allan and I were involved in the past with looking at some of the business plans, they had involved one arm of the entity looking at it without the other, and then when we get in and begin to look at, oh, here's the CFR ramification, here's this ramification, that ramification, they go, oh, we weren't told about that. And that's not, this is not a situation saying attorneys don't know it. It's just their different expertise that can bring a wealth of knowledge, and it's really good having a solid team help you work through all these ramifications, because, you know, you clearly heard Allan talking about CFR, tax ramifications, all those other elements. You know, an attorney is absolutely essential to help you get the right fit of legally what needs to be done with all of the elements that are required for corporate entity structuring.
And the right attorney. Okay, your labor attorney is not going to be good for this. Your general corporate counsel might not be good for this. You do need to have somebody who understands corporate structures, establishing businesses, and closing down businesses as they go forward. Less of a concern with regard to not-for-profit expertise as opposed to general corporation expertise and how these structures really should be formed.
So that's a huge takeaway as far as I'm concerned when you're looking at this. Involve both. Absolutely critical. Considerations in the change process. Again, if you decide that this business isn't going to be happening going forward, you need to really be looking at cost reductions. I know many of us in human service say, oh, we'll find a job for this person here, or we'll pick this up over there. You potentially are really hurting yourself long term, and we'll be getting into some specifics to look at as it relates to administration, property, and fixed cost, as well as inventory. But you have to be prepared when you move into, let's say you decide to go into conflict-free case management and unload your MSc program, for example, or you want to merge your employment center into you've got to be prepared to really pull out those costs that may not be as obvious quickly and really figure out how do you trim your expense, because otherwise you're going to be carrying significant amount of costs going forward that could impact your overall health, fiscal health of your organization.
Okay, so certain things like historical costs in terms of personnel. So, we talk about absorption of staff, we talk about unemployment costs if we are reducing staff. That could be quite significant. There also are certain laws out there if you're reducing your staff of over a certain amount of numbers. We do have to worry about the New York State Department of Labor and those requirements with regard to warn notices and so on. But certainly reallocation of staff is not the answer. We've dealt with that quite a bit over quite a number of years where organizations close down programs and we ask them, okay, what's the impact? And they tell us, well, we had a bigger loss. And the answer was, well, we kept the same number of staff on board. We did not reduce any positions. And, at the end of the day, you are less viable going into the future. So certainly something like the absorption of staff really needs to be thought about very, very importantly. We talked about a little bit earlier about administration cost redistribution. Came up with a very good model, which we'll look at in a minute, in terms of the ramification and the impact on that, because we do have to worry about that administrative pool and whether or not your administrative percentage is 12% or 18%, whether it makes sense for your organization. You have to make that determination at the end of the day, but we do have to worry about the lack of funding. With regard to administration, I always take into consideration all the unfunded mandates that everybody does have, and that does drive up the administrative costs themselves, but we do have to think about this effect. And again, the overall impact on the budget and fringe benefit costs. Do we then have significantly increased percentages? Are we viable with regard to that? For instance, health insurance is always a big, big area, becoming a much larger area going into the future. At the not-for-profit that I'm on the board, we are at least small enough that we are in a community-based insurance plan, and they changed the laws over the past couple of years that increased that number, I believe, to 100 from 50. So we were able to deal with being a small plan for another couple of years. But as we then go out into the general marketplace with regard to the health insurance, our potential costs could go up significantly. And while we're trying to save money, this could impact us on a negative basis.
There's so much to consider when you're looking at any of this, and we think the business side's the easiest part, but you really need to go much deeper than just the business side looking at all of this. So, for example, if you decide to close a program and you do not reduce administration, I want to go through this example so that you have a flavor of how this might impact your organization. So I am assuming that your agency's total budget is $15 million. Your administration is 12%, and again, I've just made these numbers up, but the math is really what's critical here. So the annual cost for administration is $1.8 million. You look at your program revenue. So this program that you may be offloading is $5 million of the $15 million. So you have a ratio value of the administration cost for this program is really $600,000. So basically, if you do not reduce administration, you've got an added $600,000 in expense in the rest of your programs. So your administration percentage all of a sudden moves from a 12% to an 18%. So in reality, if you are looking at closing a program, you have to begin to look at all those administrative costs associated with it and see, in fact, how can you trim down to really make this viable.
And it's not always going to be in personnel. There may be other costs that we do have to reduce also, plus never mind the direct program costs that we're not even focusing in upon as part of this discussion today. There are a lot of ramifications with regard to this and how that $600,000 in this example will then be absorbed or carved out of the P&L of your changed organization.
Again, I often reference, if you look, I probably should have put the no in a different color. If the expense needs to be absorbed with no associated revenue, you always trying to find a place that the revenue can be absorbed. But in reality, what I'm talking about is their added revenue to cover that added cost, not just, oh, we can put it in and that's okay. It's really looking at the fiscal hit on this in reality.
Now, things like property. So as we're getting into programmatic costs, property is one of your larger areas that we do have to worry about. And let's think about a workshop. And I'm going to talk about group homes as part of today's discussion. But if we have a workshop and all of a sudden we decide that we are not going to operate it in a for-profit type of a business, or the workshop is embedded within your structure, within your facility, what do we now do with all that space? So were there any ramifications or restrictions because we used IDA bonding monies in order to renovate, in order to rehabilitate that part of the building? There are ramifications with regard to the Internal Revenue Service, with regard to those tax-exempt bonds, and we do have to think about what type of value there is available and how we can repurpose that type of a space. If the workshop was in a totally separate building within your organization, and that building now is vacant or cannot be repurposed, and we have a long-term lease, are we on a hook for that for the next 5 or 10 years? That's a very important thing that we have to worry about. Do we have any what we term good guy clauses within those leases where you can pay 3 months rent and get out of it? Things that you need to think about with regard to how that might impact you, and of course the physical plant operating costs, utilities and maintenance spread out amongst existing programs as opposed to the larger type of an entity, and how that might impact you on that going forward basis.
You think about it, when you close a program, let's say a workshop, and you still have that property, it has to be maintained even minimally, and utilities have to be maintained even minimally. So even if you can't redistribute the cost, you still have these costs that are going to be carried going forward. You can't let a property go into disarray because that will also hurt the value for resale if you want to be doing that. And you know, we know heating in the Northeast has to take place during the upcoming winter months, or you're going to have significant problems dealing with the physical plant. I hate to say in my community there's numerous businesses that have gone out and you look at the brownfields around anymore and the value of those properties is next to nil. So it's really critical that you really have kept things okay or find a substitute business venture for that, because you really don't want your property labeled as a brownfield because it really makes the marketing even worse in reality.
Yep, and here in New York State we're dealing with a lot of zombie residences. I assume that we can use the same term with regard to businesses. Certainly driving certain places in the lower upstate portion of New York, you see a lot of vacancies, you see a lot of what Laurie's talking about, and that is, it does have an impact on the organization. So you'll see on this slide just a re-verification of what we're talking about. Depreciation expense will continue. If there's no program to charge to, that's going to be going to administration. Your administrative percentages are going to be going up. Your reimbursed costs will be going down. You know, just as an example, $30 million property, 15-year life, depreciation is $2 million a year. Let's say we have five years still left on the property. So on the estimated useful life, that is quite a bit of additional expense that you're going to take as a hit. Yes, it's a non-cash item, but you know what? I can explain to the banks till I'm blue in the face that, you know, this is a non-cash cost, but they'll come back to me and say, what? You still carry the property. Again, as Laurie said, you still have utilities. You have all these different things that will impact you. So if disposed immediately without sale, we might have $10 million potentially impacted on the bottom line. If we have a loss on the sale, that could also impact us, but I think everybody does get the understanding with regard to property costs themselves.
I know Allan went through this very quickly, and being an accountant, I totally appreciate it, but as an exec, I did not always look at this stuff, and thank God I do have a master's in business and had to take some accounting courses. So it is something front and center in my mind, because we often don't think about the depreciation expense, and it is something that gets carried forward, and that includes equipment as well as your property elements. So it's really critical that you understand what are those elements that are in that expense account so that you know know, do you have carrying cost of depreciation going forward? This is the life Allan lives all the time, so I know to him it's like, oh yeah, this is no big deal. To someone that's running program, it's probably not something you've always thought about all the time.
And then, you know, a little bit of a different thought process, less accounting. Basically, no, it was just no.
Okay.
So basically, as you're looking at it and you're thinking about properties and the costs of the viability of those properties as you go forward, let's say you as an organization do decide that we are going to shut down our workshop. And then you make that decision that the property that we're in right now just is too big, we can't repurpose it, we're going to have to move to a new location. There are costs with regard to that move. We have moving costs, we might have renovation costs. Where we can get the money to fund and seed those? And yes, hopefully if we are leasing, we can get the landlord to buy into part of those renovations. But very importantly, as we are understanding it, there are different tails that we have to think about with regard to expenses or items with regard to that change in our business structure on that going forward basis.
With the equipment side of things, it's not, you know, the useful life of property is usually much longer than equipment, so again, you might not have the fiscal hit for as long. So yes, I did this combination together, but you really need to understand the useful life that's left on each of those elements based upon what's defined in accounting terms overall to really determine what your ongoing carrying costs will be. I have had experience of closing a segment of a business in my previous job as an executive director of a work center, and we had closed a business that was not doing very well and someone else picked up that business. However, we did have inventory on hand, which often is the cost, you know, cost of inventory or work in product. And in reality, we were not able to offload that component. So it's something that will have an impact to you. So it's just something you need to be aware that if you're into a manufacturing setup and you're carrying inventory, there is a cost for writing off that inventory if you haven't been doing that all the way along. So it's just another segment that you need to be thinking about, because this can hit your fiscal statements, and having this hit all at one time can have really a detrimental impact on your financial position. So other considerations, do you have unrealized liabilities? You know, do you have uncollected revenue that you have out there in reality? And are you able to collect that AR at this point in time? If the businesses know that you're going out of that business, are they as likely to pay you? And it's something that you need to be considering. You have to realize too that even though you may go out of a business, remember, if you've been billing Medicaid, you do have claims that are taking place that have a look-back time frame that, in fact, you could have some exposure. That exposure doesn't go away because you stop the business today. That gets carried forward. So it's just something that, I'm not trying to alarm you, but it's just because today it ends doesn't mean your exposure elements are gone. You still have all those statutes of limitations that take place from work that's been done in the past.
And if you are going to go through some type of merger or acquisition, this is probably one of the most unknown areas that as you're going through due diligence, how do we understand what might be out there? I went through recently an organizational merger. Two not-for-profits came together, and there was significant due diligence on many sides. And it was really amazing at the end of the day in terms of the unrecorded liabilities in program after program that even after the due diligence were not identified. And it was only through the work of the fiscal department over the next year to 2 years where they did understand and they did learn what those ramifications were. Every time the rock was picked up a little bit further, they figured out they didn't have documentation, they didn't have the right information in order to further bill for denials or for claims that were not fully paid. So we do have to, again, worry about this area and the ramifications to you as an organization. Of course, also debt covenant requirements. Because if we are changing our business, if we are giving up a portion of our operations or a portion of our fixed assets, can we still maintain these debt requirements as we do go forward? I've dealt with quite a bit in terms of these financial ratios. Many organizations right now are teetering right on the brink of the ratios themselves, getting right under the wire in terms of the maximum potentials that they might be allowed to have. So we do have to think about that. We do have to have discussions with regard to our financial institutions to let them know these changes might be coming down, figure out what the impact might be, discuss with them changes in the potential debt covenant requirements if they would be willing to do so. So each of these areas need to be thought about with regard to the debt covenants, the considerations of unrealized liabilities, and as Laurie had indicated, very importantly, potential for AR reductions or uncollectible receivables within those programs that we might not be operating as we go forward.
Yeah, I've been fortunate that my history has given me many opportunities. I happened to close an Article 28 clinic, and with billing in an Article 28 clinic, payments aren't always prompt and quick, so you're always stealing lags. It took us almost 3 years to really effectively close the overall thing down, just because the revenue cycles that take place with insurance companies and all those other elements. So, you know, again, it's just really knowing all those exposure elements you're going to have, which, again, do the homework up front. That way there's no surprises on the financial statement when you're finally at that point in time. We're not trying to scare you, but it's just areas that have to be considered.
So as we move into a different business structure, thinking about a for-profit business structure, where do we access capital? Will a bank be willing to give us money? As I think we talked about a little bit earlier, but I think we've also experienced in our personal lives, the banks are getting much tighter, they're getting much stricter with regard to these things. I think a great example is part of this, and it's not alone, but I have a daughter. She's 18 years old, decided we need to establish a credit history for her. I told her to go apply for a credit card. She did. They gave her a whopping $500 credit card limit. Went off to college. We all know how expensive books are at the universities. She said to me, "Dad, how am I going to pay the bill?" So before she left, we called the bank, and we said we'd like to increase her limit. So they asked her a whole bunch of questions, what her income was, what she needs the money for, all these different things. Went off to college, didn't hear a word. 10 days later, get a letter in the mail. Basically what they said to her was, we are keeping your limit at this whopping height of $500 because, one, you don't have enough credit history with us, you don't have enough payment history, all these different things. So think about that with a new business, the viability of it. Yes, we can go to a small business administration. We do need to think about outside the box in terms of those capital needs of how we might be getting them. So will there be an investor? Will we be attempting to obtain some type of small business administration loan in order to make that business viable? So this access to capital has to be a very, very big focus in terms of that structure change and whatever we're going to do with the viability of a new operation.
With the work center, you know, because it's embedded as one of our programs in our operation, we often don't think about all the administrative supports that take place. I mean, the areas that do it may think about it, but beyond that, it's not often thought about. Yet these functions need to continue. You're still going to be purchasing things in a new corporation. You're still going to have an accounts payable. You're still going to have an accounts receivable. You're going to have the impact of employee benefits. Do you carry that going forward or not? You really need to look at, and it's possible to set up a structure that you can buy those services from your existing organization. However, remember that might be unrelated business income at the same time for that organization when that in fact is set in place. Mm-hmm. So you need to be looking at all of these elements of who in fact and how are these functions that are automatically built in brought forward. The cost and transferability of employee benefits is huge. Most non-for-profits have a very nice benefit package when you think about it. And when I look at for-profit businesses, you're not seeing benefit structures of 25, 30%. In reality, it's not unusual to be running around 12, 15%. So again, when you begin to look at the cost of benefits, that is a significant component. So how are you going to recruit staff if you don't have this rich benefit package overall?
And think about simple things. In for-profit businesses, the world is very different. Take for consideration the fact that the state, I don't know for the full state, but I think they did, but here down in New York City, they passed a sick leave law because many for-profit businesses that were small and some larger ones did not provide sick pay for their employees, and that is very common. So they implemented a law that businesses over a certain amount of employees are required to pay sick time and the like. So there are ramifications or different ways of operating these businesses in terms of what you need to think about. So benefits, very, very important. Unions, as Laurie said, because those are and do crop up quite a bit in terms of potential when employees are not happy. But we do have to understand how that's going to impact us, and working capital, as we talked about before, in terms of the access, making sure that we do have that that correct amount of money for the business to operate appropriately.
And there is a reason why the access to capital is different than the working capital. Often we think of capital as the startup costs. Working capital can kill you going forward. If you don't have the funds on a going forward basis to pay for that inventory or payroll or whatever while you're waiting for the revenue to come in the door, that is really what we're talking about with working capital. So yes, you need capital for the building acquisition and property build out and all of those elements, but working capital is essential and can quickly kill a business if you do not have it.
Yep, and as an example that I used in a different conversation, a relative of mine, very close of mine, relative, opened up a business, and sad to say, 10 months later, they were out of business. And one of the primary reasons were the fact that they did not estimate the startup costs appropriately. Where they budgeted a certain amount, it actually came in more than double. They never got past that nut in terms of the business, and it did close down after 10, 11 months, even though it was a very good idea, it was a viable business. But the problem was, again, they didn't budget it, and then somebody came in very close to them in a different location and opened up a store half the size and became very viable because they did not spend all those startup dollars as part of the process. And in our world right now, startup dollars, you know, we can get reimbursed from the state, or we were able to get reimbursed funds for it. When you're going into for-profit ventures, it is you, and it is your investors at that point in time. So successful for-profit businesses have several common traits, and I think you might understand that we've been focusing upon these as part of the entire conversation here this evening. Of course, focus on profitability. If a item or a line of business is not profitable, we do have to think about either cutting costs, how do we expand revenue in a real good manner, but make sure that that profitability is there. Part of that is elimination of waste and inefficiency, and really looking inherently in a business as to what costs you actually need. And if you ever looked at a for-profit and you said to them, well, how come the owner is doing so many different things or wears so many hats? Part of it is that they can't afford to hire somebody. Part of it is that they want to make a small bit of a profit within their business. But most importantly, they don't have the ability for any waste or inefficiency in order to be profitable within that organization. Things like the ability to change on a dime or strategically is going to be very important. We talked about that quite a bit. Do we have the right mentality in terms of what needs to be done? Do we have the strength to make the hard decisions on the day-to-day basis to make sure that we can move this all forward? The funding, the capital within a business, again, we talked about that. And is it there? Do we have a clear vision in terms of what that funding is necessary and the model and how it's going to operate on the going forward basis, and an overarching throughout everything that we need to think about in a for-profit business, low fixed costs, low costs in general, because we do need to make sure that the revenue is viable. And, you know, we can't do things like you read in the paper, it's the sad case about the EpiPen, for instance, where they increased the cost of that so many hundreds of percentages. You know, they're going to get hurt because of it. The AG started an investigation already, but that's not the way to operate a business. That's not the right way to be viable going into the future. But each of these 6 items that we've listed here on this slide do need to be thought about, do need to be taken into consideration on a day-to-day basis throughout this planning process, throughout the way that we're going to work forward into the future for that new business venture itself. So a lot of different options in terms of corporate structures. There's a lot of different things they need to think about with regard to viability. But most importantly, if we can put it there, and then I'll give it off to Laurie to finalize up this portion of the session, do we have the thought process in-house within the organization to do this the right way? Do we have the strategic vision in terms of moving this all forward? And most importantly, is everybody fully committed to following this through and making sure that it does work out? Because in the not-for-profit world, it is a little bit different. Yes, you have a lot of pressures. You have a lot of things that you need to work on. But even in the not-for-profit, where I'm the president of the board, I have my loss leaders. We talk about them. We talk about eliminating those programs, but do we ever get to it? No, because we raise a little bit more money within fundraising. We are comfortable with a $100,000 profit instead of a $300,000 profit. But then again, what is the impact on it? When was the last time I gave a raise? When was the last time I increased certain things? My costs have gone up because we've taken more of the cost with regard to our employees' health care, which seems to be increasing exponentially each year. So a lot of things you need to think about with regard to these new ventures, and thinking before doing is very, very important within this process.
So we've touched upon a lot of areas that you need to be thinking about, and I think the key focus or takeaway we wanted you to really think about, yes, there's many new models you can get into. Do your homework on what's going to remain and be carried forward, because that will directly impact your CFR and your administrative cost going forward. So you've got to be prepared to make those hard decisions if in fact you are disenfranchising yourself from some arm of business. It can be work center, it could be MSC for the future, or whatever other arm of business you're actually looking at. So there's much to consider.